Well, good afternoon, everybody. Welcome back to another episode of the Industrial Real Estate Show. I am pleased to be joined by Clint Murphy, 25 years of experience in finance and real estate. And I think I read on your bio, Clint, you've done $2 billion worth of transactions over your career. First of all, thanks so much for joining me on the show.
It's great to be here. Looking forward to having a fun conversation with you.
Yeah, me as well. And it was funny. We just before we hit record, we were talking about how real estate can be compared to stocks in a certain way on whether you want to have a blue chip stock or a blue chip piece of real estate. Can you take us back to the conversation we were just having? Because I think that what you were saying offers a ton of insight, and I think that's just a great spot to kick this off with.
Absolutely. When we think about real estate, one of the key things to think about, everyone tends to always zone in on one thing. They zone in on cash flow. And cash flow is absolutely important. Cash is king. Probably no more important a time than right now with the amount of uncertainty that's in the world. But there are a couple other spots of real estate that are just as important. One is your principal pay down. So you and I were talking earlier about a property you've owned that's had no real appreciation, but you've paid off half the mortgage. That's an increase to your net worth. So you have cash flow, you have principal appreciate or principal pay down. And then number three is you have the appreciation in the value of the real estate. So if for those listeners who want to talk to someone who doesn't know real estate, I like to equate that to stocks. And the way I look at it is you have, let's call it a FANG stock, your Facebook, Apple, Amazon, Netflix, and Google. And that tends to be your high cost of living cities. Here in Canada, think Vancouver. Down in the US, think San Francisco, New York City. If you're buying them, you're not going to meet the American 1% rule, but you are going to look forward to long-term high appreciation rates on those properties. Generally, they're landlocked. Generally, they don't have the ability, like a Texas or like a Calgary or Edmonton here in Canada, to simply add a ring to the road and get bigger. They have to go up. And so single family townhouse, they don't have the ability to reproduce it and grow the stock. So you generally see high appreciation. The further out you go into the burbs, let's say you go about 45 minutes out, you're taking a car ride in or you're taking a train, those might be your blue chip IBM-like stocks. You get a small amount of cash flow or a dividend, and you get some appreciation over time. The third group is your pure cash flow play. That's the type of asset you were talking about for yourself or industrial, where you probably bought that at a 6.5 cap or a 7 cap, and you're printing cash, you're paying down your principal, but you look at your property assessment and you say, well, holy shit, this assessment is the same as it was 11 years ago. I've had no appreciation. That's a pure dividend stock. You're just getting your stream of cash flows over the life of the asset with very little to no appreciation. I have a friend on Twitter who owns properties in the US, and he's been able to build a portfolio of properties. So he'll say, I have 20 doors. And if you or I were in a high cost of living city like San Fran or Vancouver, and we were doing that over the timeline we would think our portfolio doubled or tripled in value. The value of the portfolio is the same, but he's just spitting out cash every year because he's in that exact same type of market as you, where he's buying 6.5 to 7.5 caps, no appreciation, pure cash flow.
That's so well said, and I've never looked at it from that perspective before. But I had this conversation with someone the other day. We were talking a similar type of story, and the one line that I've heard many years ago and it still resonates with me is flat land, flat rents. And it alludes to what you were talking about is if you can grow in every direction, then conceivably you're only constrained by the cost of bringing services to a new parcel 5 minutes down the road. So you've got to bring utilities, you've got to bring roads and lights and everything that goes with it. But provided you can grow in every direction, you do have that almost pressure on rent staying having an artificial ceiling because you could just keep adding that next building. Whereas Vancouver, New York, you're constrained. You can't just go and add another 100-acre subdivision because you're constrained by the geographical barriers.
It's 100% accurate. And when you look at it, it starts to shape your thinking, and it starts to shape your investment thesis. And I'm a big believer that to succeed financially, you have to have a strong thesis. You have to be convicted in it. You have to have the capital to deploy into it. And then you have to have the courage to hold it to test out your thesis. So if you believe in something, you're investing in it for the long term. And when you start to hear people in your industry talk, pay attention to the land guys, pay attention to the brokers. And I'll give you an easy example. Single family homes here in Vancouver, it would be much like San Francisco. They're not adding any. You can't, right? The zoning bylaws don't even necessarily allow you to replace them anymore. So it used to be, for example, that if you knocked down a single family home in Vancouver, you could build up to 0.75 FSR, which was roughly the house that was already there. So you could build your dream house on an old, knock down an old house, put up a dream house. They lowered that floor space ratio to 0.6 so that they would disincent building single family homes. So not only is there no new land, if you try to take old land and build, you can't build your dream home anymore unless you buy a really big lot and you build a modest home on it, like a 5,000 square foot lot, and you're only going to be allowed to build a 3,000 square foot home. You used to be allowed to build roughly 4,500, or 4,000. So that's a big delta. So single family's gone in Vancouver. No more new stock. You start to hear the land guys say, townhouses are feeling like single family did 20 years ago. So if you rewind 20 years ago, there were probably 20, 30 decently sized single family home builders in the city. Now there's one, maybe two. You look at townhouses and you look at the land available to do townhouse development, and it's disappearing. So that tells you we'll be moving from townhouse development to primarily 4 to 6 story wood frame or concrete towers. And so you start to hear that, and your investment thesis starts to say, well, wait a second. If there's no ability to add townhouse stock, would I benefit by owning larger townhouses that won't be able to be replicated? And so you start to shape what you buy, where you buy it, what you look for. And I can only imagine that's the same in your world where, for example, you look in the US, and we did this at my last shop as a thesis. Almost all of the industrial that gets built tends to be very large bay. And I'm going to focus in on Seattle because that's where we looked. Tends to almost be all large bay for like Amazon's, etc. The thesis we had was, what if we take some of these large bay, older industrial sites and we cut them up into 6 small bay, and we go out and we lease small bay industrial for that, what we refer to as the last mile. And we say, hey, there's all these little shops that no longer have access because they can't compete for the large sites with Amazon. They don't need that, but they do need a fulfillment center. Everything's moving online. Maybe we can chop up these big sites into smaller sites because there is no more industrial in these areas being added, and we'll have an access to a market that's not there today.
So profound, and I loved everything you said there because I couldn't agree more with it. Not necessarily on the residential side, that's not my area of expertise, but I still appreciated how that investment thesis, even going back to that earlier point, you said you've got to let it play out. I think that's the one thing about real estate that's so fascinating, is that you might struggle. You might have 10 years of tough times, but if your investment thesis is this is a 20-year project and we're going to wait for this to happen, that is the long game that someone has to play. In particular on the industrial side, this is what I'm finding so fascinating as well. And Seattle is a good market, but that's similar to Vancouver. There's land constraints. I suppose you could start building out more into the periphery a little bit easier. But if you compare it to a market like Dallas or Phoenix, where you can theoretically grow in every direction, that's what they did. I think Dallas added 70 million square feet of industrial real estate last year, which is crazy. That's a small to medium sized market that they added in new inventory in a single year, and all of it was that big box industrial that you're talking about, and a lot of it's sitting vacant for the same reason. If you can just keep adding another building and add another building, that's what they did. On the side of taking a big building like that, a challenge that I've come across is that if you're building a million square foot distribution center or warehouse, it's usually geared for just a couple of tenants. Were the ones that you were identifying, was that a specific part of the buy box that they had to be able to be demised into smaller spaces without incurring massive costs?
Yeah, the idea, we wouldn't necessarily target like a million square feet, like a full fulfillment center. We'd more target, let's say, 120,000 square feet, and chop that up into six 20,000 square foot units. So quite a bit smaller, and you're really targeting that end user who's going to be using it as both like their manufacturing or warehouse and fulfillment. And so much smaller. And the one project we did while I was there, we actually built from ground up. So we ended up not buying a site and redemising it. We built a site.
Just a couple of questions I'd have for you on some of the challenges that you might have faced with that, because I think it sounds great. I love the idea of taking a building that doesn't work because there's too much of it for that what's called 100,000 square feet and splitting into smaller bays. Did you come across challenges such as the cost of just even installing those demising walls? Because if you're 28 feet and you've got to have a fire rated separation wall in between those, that ceiling height, that length of walls becomes pretty expensive. And then also adding in that a single 100,000 square foot building might only have one washroom. So then you've got to go and trench all the utilities to bring the services to all the other bays. Did you run into problems where it just became prohibitively expensive to actually separate it and have self-contained units? Or was that just something that the market could justify if you were able to do it?
I think the biggest challenge, it's hard to say what the problems were, because by the time we completed that first project, the market had turned in such a way that we killed the thesis. Like we stopped going doing it. So by way of background, the shop I was at while I was doing that, one of the larger residential developers in Vancouver, and this was a side business that we were going to pursue in Seattle.
Uh-huh.
So we went down, started right when we were starting with the thesis, COVID happened. And so we couldn't cross the border. So it killed it for about a year or so. And then we could cross the border again. So we got started on one. But then, Chad, you may have dealt with this in Edmonton. They came out with new tax rules about US Canadian business called EIFEL. So there may be people on the podcast that hear about the EIFEL rules. But basically, if you had investment in the United States and you didn't meet certain requirements, it would be considered passive investment, and there would be very negative consequences to your Canadian portfolio. You couldn't deduct interest beyond a certain percentage of your EBITDA. So basically, if you had an income portfolio in Canada and you had investment in the US that was passive, you wouldn't be able to deduct all of your interest on your Canadian portfolio. So most people who were in our boat, where they were starting like something small that was still passive, we didn't have 5 US employees. We killed the business. We just shut it. We just shut it down. We didn't even we never got to project 2.
Wow. Well, yeah, that's the world we're living in, a constant change. And it's not just change in things that people hear about with tariffs and the top of mind news, but it also gets a lot more granular where you start having tax issues and you have to restructure things. That does change the thesis pretty quickly. I guess that would lead to the next question is how often are you looking at your thesis and saying we need to make this change, this needs to be altered, we need to pivot, or because that's the one thing that I think a lot of people struggle with is they want to make an investment thesis and they want to say, we're going to, here's where we think the market's going to go and we're going to hold this for 10 or 20 years, but then something changes radically.
That's right.
Industrial is a good example with they're a push to try and reshore everything back to the U.S. Does that change the manufacturing landscape in other markets? So how do you look at your investment thesis? Is it an organic, living, breathing thing that you've got to water and tend for, or do you just say we're going to try and lock this in, and until our hand is forced, we're going to continue on that path?
No, it's rigid flexibility. Let's use a term like that in that I like to have 5 to 10 year vision of where we're going. One of the things I loved about the shop that I was at, and now that I have my own development shop, we have a similar mandate, is looking at it and saying, like right now, we'd be looking at Mission 2030. And it's by 2030 or by 2032, because it'll take about 7 years to get to where we want. By 2032, we want to be achieving this in the business. Because then what that allows us to do, Chad, is to say, well, if that's our goal, our goal is to have closings of, let's say, $150 million a year per year, every year by 2032. Well, to do that, we have to buy enough sites, if it's a 5 year life cycle, to hit it by 2032. By 2027, we have to have 150 million of revenue under contract. And then in 2028, we have to have 100. You have to do that every year. And if every year you're buying 150 million of revenue under contract and you're executing, by 2032, we're going to be closing 150 million a year. So you have that. Here's the 7 year goal. It would have been an 8 year goal when we set it last year. Here's the 8 year goal. Here are the steps we have to do to get there. Here are the number of sites we need to acquire per year. Here's the size of the sites we need to acquire. Here's the mix we want to do between townhouse sites versus wood frame apartment buildings. Here's how many townhouse sites we want to have completed before we start wood frame apartments. So once we have that, that's a bit of a roadmap that guides the future. But there's going to be detours. There's going to be things that happen. And for the audience who's listening, here in Canada, there's been a significant shift in residential. And I think industrials weathered it much stronger than residential. One of our largest investors is a very large industrial real estate company here in BC. And so I get some glimpses into how things are going for them. But on the residential side, once the tariffs, real estate had already been in trouble roughly since mid-2022. Relatively flat. Looked in January like there was some optimism for the future. When the tariffs were announced, residential real estate froze a little because of uncertainty. Investors, buyers, nobody likes uncertainty. Then we had an announcement of an election, more uncertainty. Then both parties who were running for government said, hey, we're going to eliminate GST in these circumstances, which is a tax here in Canada. We're going to eliminate that tax on home purchases below a certain value. Both of them said a different value. One of them said for first-time home buyers. One of them said for all buyers. But what that did, that was the ultimate uncertainty. If you're a realtor, it's your fiduciary duty to say to your buyer, hey, let's sit on the sidelines until that rule gets put in place, because you're going to save $50,000 to $75,000 on the purchase of your house. No brainer. But what that means is everybody sat on the sidelines. So uncertainty, sideliner. In that situation, I would be crazy to continue to march down that path because it was the 8 year goal. You have to look at each other as partners and say, hey, we need to pause the 8-year goal. We need to reassess. Where's the market going? What's happening with prices? We need that to work its way through the system. And then we can and then we can pick up the march again. In the meantime, let's really focus on the projects that are already under our control. We've either closed on them, we're firm on them, or we're still in the subject period. And let's make sure they still work. And if they don't work, let's get to the negotiation table and have the conversations we need to have to turn them into real projects.
Do you find that people underestimate how much uncertainty is in the development cycle? Because if somebody just goes and buys an existing asset, and if it has a tenant in there, that proverbial core asset, you've got a long-term tenant in there, and you're just buying it, you know what you have. You're in the development side, you're pure value add. You're taking land, or you're taking an existing building and demolishing it and doing a ground up development, which that cycle presumably is 3+ years. How would the average developer handle those fluctuations and all that uncertainty when they have a multi-year development cycle?
I believe 99.98% of the population does not understand the uncertainty and risk that comes with the development cycle. And even within the development cycle, even within the development world, I would say the majority of people in that world don't even understand the risk and uncertainty that's involved in that world. When you really start to understand it is when you are an owner of a real estate development company. And why I say it that way, Chad, is take me as an example. I was a CFO of one of the largest residential development companies in Vancouver for a decade. My understanding of the risk and uncertainty over the last year as an owner is exponentially higher than it was as a CFO. Because if you're in a single silo in a development business, you're insulated from all the other silos, right? I understood the full picture, but I didn't myopically understand the risk that comes with the development itself, right? The approvals process, the pain you go through with staff and council, the emails from neighbors about how they want to save their trees and how the canopy of trees is more important than adding housing stock when we have an effing housing crisis. Whether you're in the US in a high cost of living city or you're in Canada in a high cost of living city, everyone's talking about a housing crisis, but all the emails are about saving our trees. And hey, I think you should be able to do this development with half the density you've put forward in your application. Like, are these people crazy? No concept of no. If we don't build exactly what we put forward, we won't make money. And I love what I do, but I'm not doing it to not make money. Like, there has to be a minimum amount of profit. And here in Canada, the amount of profit we have in our pro formas is significantly lower than what our American listeners put in their pro formas. So you look at it, and it's a lot of risk for an okay amount of reward. And that reward is higher when you leverage it. But even if you're on Twitter and you're reading the hypotheses that people are putting out about how to solve the housing crisis, most of these people are suggesting things that will make housing even worse. I read a take today that said we should tax investors. Like, do people not realize housing only gets built if investors are willing to say to a developer, we'll put money into it, so you build it, or we'll buy you're building a 50 unit development, we'll buy the first 20 homes so that you can prove to the bank that the values are real and you can get started on construction. If you start taxing the investors and the investors walk away, developers aren't going to be able to build. And so you look at this and you say, okay, these are academics who have PhDs who are at universities, and this is the shit they're writing about how to solve housing. They have no concept of how it actually works. So yes, I don't believe that the average person out there actually understands how real estate development works in the city. And yeah, I'm going to let the red go there.
I I love
Pass
it.
it back to you.
I love it because I even myself I own real estate, but I've never done a development myself. So it'd be similar to the previous role you had, where I've been involved in it in either a broker capacity or an advisor capacity. But I've never actually been the one writing the checks. I've never been the one dealing with the angry neighbors or dealing with council that doesn't want a new industrial building built in this area. So I haven't been nearly that in depth on it to understand it. So I'd love to actually dive into that with you a bit more though, and say, what have you learned? You learned more in the past year being the guy that's in charge and actually doing it than being in more of an advisory supportive role, because you were the CFO of that company, I
Yeah,
believe,
I
right?
was CFO, so I would have been in charge of IT, tax, corporate accounting, development accounting, financial planning and analysis, so raising capital. So anything along the lines of money would have been involved in. I sat at the shareholder table. I sat at the leadership team table for a decade. So I was involved in all those conversations. But at the leadership team table, as an example, when we were having major issues with a development, I'd hear what people were talking about, but it wouldn't be my world. So I wouldn't have deliverables or actionables. Whereas in the current business, there's four shareholders. We are all the employees, a marketing person, a deal person, a development person, and me, right? Which is kind of back office and a bit of overseeing kind of directionally because of the role I had in the last shop and bringing that to us. And so now I'm involved in those marketing and sales conversations. How are we pricing these homes? What are the comps look like? Hey, the market's moved. We need to move. How are we going to determine what that move looks like? On the development side, I'm sitting down with the development guy, and we're all doing this together. Sitting down with the development person and saying, "Hey, what type of product should we be building here? What can we fit on the site? What do people need and want? And how are we going to get that through the process?" And these processes can take, so give you an example. We built here in Vancouver. I would imagine this would be a lot like California. So the development process can take about 2 to 3 years, and the construction process will then take about 2 years. So you're anywhere from 4 to 5 years from the time you buy that dirt until you close. And so you can imagine that's a lot of risk and uncertainty. So a few things happen. One, the best way to manage that right now is to buy time. And so because a lot of transactions aren't happening, which is a sign of negative news to come in the future, because if it takes 4 to 5 years to deliver, but developers stop buying dirt in 2022 and haven't really started buying again, 2026, 7, and 8 are going to be very bad. So all of these pundits who are telling us their thesis on how to solve the housing, they don't even realize how much hurt we're going to be in from 2026 to 2030 because people aren't buying land. And if you're not buying land, you're not going to have homes to deliver. The homes they're going to deliver are sites they already owned. So what's happening is the bigger developers are working their way through the pipeline that they had built. So they had a large pipeline that they could take down over time. But at some point, the pipeline cookie jar empties and they don't have land they could build. And smaller guys like us aren't coming in because it's not viable. So I expect starts from 2026 to 2029 are going to be very low, and it's going to be very problematic for housing across the country. So take a step back. What do? We go to the landowners and we say, "Hey, look, you see what's happening in the market. You see what's happening with pricing. You see what's happening with uncertainty. You see that there aren't any trades. So here's what we're going to propose. We're going to put your site under contract. We're going to dribble you in a little money over time. And we're going to close on the site in 3 years. We'll go firm on it in 2 years. We'll close in 3 years. That gives that homeowner a number. It gives them some money over time. They're seeing that you're progressing it because you're still incented to get that thing approved as quickly as possible. So they're seeing the applications, the pre-application, the development permit application, the rezoning application. They're seeing that you're moving it forward. You're dribbling in money to them. And you're assessing the market the entire time. And at some point, like with what we're seeing right now, you go back and you have to have a conversation to say, hey, one of the reasons we put it under contract the way we did was because the market was really uncertain. And you're seeing the same headlines we're seeing. You're reading the same things we're reading. You're hearing the same things we're hearing. We need to talk about the final number because the final number doesn't work anymore. Prices are down 8 to 10%. That would wipe out our project. We can't go talk to our investors and ask them to put money into something if it's not going to make the right amount of money. It's not going to generate a return for them. That wouldn't be risk respectful. In everything you want to do as a developer, they're some of the most risk respectful people. Everyone thinks developers are cowboys, right? They're some of the most risk respectful people I've ever seen because they know that 1 or 2 or 3 failed projects means you're out of business because the house of cards starts. And so you have to be very risk respectful, maintain a certain amount of working capital, maintain sufficient cash reserves, ensure that when you're signing up to borrow money, that you don't end up with Silicon Valley Bank where your maturities don't match with when you have to pay the money back, right? So you don't have maturity mismatch between your assets and liabilities. So that if I'm borrowing money to invest in a project, the repayment of that money ties to the culmination of that project, right? So I'm not going out and borrowing corporate notes that have a timeline of 1 to 2 years when the project's going to take 5 years because I won't have the money to pay it back. So you're really making sure that you can buy time on projects, that you're securing enough working capital and cash reserves, that you're building sufficient margin into the project so that if there is a bit of a hit, you can weather the storm, and that you're having a match between your asset and liability maturities. And the one problem you have, Chad, is right now with the market where it is, you can get that time. When the market's hot, buyers want a 60-day. I mean, you probably see that they want a 60-day DD period and a 90-day close. Mm. That removes the ability to get any certainty. That puts puts all the risk on that developer. And so you really have to figure out where in the cycle am I doing my buys? Where in the cycle am I loading up the cupboard? And maybe it's, when the market's where it is now, you're loading up the cupboard because you can get time, you can get terms. And when the market gets to the point where people want a 30-day DD and a 60-day close, you say, hey, maybe that's a sign we should step back. Things are getting a little frothy. Let's let the market do what it does and let's come back in when things are more reasonable.
That's a very profound statement. And that whole part was really well said. When you're looking, call it a 5-year, just to round up to a nice easy number. When you're looking at a 5-year development, and maybe if you included site selection, like you're actually going out and looking to identify sites, and then you find one, and then you close on it, and you do all the behind the scenes work, and then do the build. Maybe it is closer to 5 years. How do you determine with any degree of confidence what either rental rates or sales prices will be 5 years down the road when we don't even really know what's going to happen next week with all the uncertainty in the market?
And you can't. And here's where people get themselves in trouble. So the number one way that we do it, and so I would say one of Vancouver's largest home builders, my buddy's the CFO there, and most of the shareholders from the last shop I was at came from that shop. And we had the same mantra. It's today. What can we sell this for today? What would it cost to build this today? Right? We have a number of projects underway in these areas. We know the costs, right? We have reasonable certainty on costs. That's going to inflate. Okay. We know what you can sell it for today because we're selling today. We have products selling in those marketplaces, and we've sold 1,000 of this plan type in that area. So we know the revenues today. We know the costs today. Does the project work today? If it works today, it should work in 5 years. There's a lot of risk there, right? If it works today, it should work in 5 years. Imagine you made that call May 2022 when prices were up here and costs were here. And since then, so that's what you're seeing in here in Canada. You're seeing it a lot in Toronto, where prices have come down about 20%, I think, 10 to 20% over the last 3 years. And so people are underwater and not closing on condo. Here in Vancouver, you're probably 8 to 10%. And so revenues have come off, costs have continued to move. And where as a society we're getting ourselves in trouble, I think this is happening in places like California for the US listeners. Tends to happen, I'm going to say, more in blue states than red states, including here in Canada. Happens more in Vancouver than it probably does in Edmonton. Is all of these zoning and code and energy and virtue ideas that work their way into construction. So the increased costs that happen because the homes have to be more energy efficient, carbon neutral, you need thicker walls, you need more wood, you need more insulation. You just keep adding, Chad. You keep adding. And in our ability to deliver that exact same home that is now worth less than it was 2 years ago will cost us more to build. Even if costs stayed the same, it will cost us more to build because you've changed the rules. The municipality, not you, Chad. You've changed the rules in a way that make it prohibitively more expensive. They're adding in adaptability requirements, which for every home in an apartment building would add about 50 square feet to that unit. So if you had a 650 square foot unit, it's now 700 square feet. Probably can't sell that unit for anymore. I probably can't rent it for anymore. It's still your 2-bed. But I had to add 50 square feet of costs because the 100% of the homes have to be adaptable, even if only 10% of the population needs an adaptable home. You do the math on that one. I don't understand it. They're putting in new seismic requirements, which require more shear walls, more wood, more. So you just look at all these rules, and they're adding exponentially more costs to deliver the same product that's now worth less money.
And there's people out there that want to be developers.
Yeah, don't do it.
Well, that as you're saying that too, I was even just trying to extrapolate the timeline from a financial standpoint. So you start day one, you secure a parcel of land, and you say this is going to be for a 5-year timeline. You have zero income coming in for that 4-year, 5 years. So from just a time value of money perspective, you've got your upfront investment, and then you're going to have continuous investments that you're making over that 5-year horizon. And then you ideally have some exit at the end of that 5 years. Maybe it's a refinance, maybe it's selling the project out. You need to have a return that not only makes sense for that whole 5 years where you were making zero money, you also have to have a return or a projected return that accounts for all that risk. Like you were saying, the development risk, the change in the market, change in how things need to be done, change in codes, change in buyer preferences, all this plethora of different factors coming in so that you can make a 5-year projection and hope that the demand is where it needs to be at the end of it. Development's got to be a game for those with big brass balls, I would think.
100%. 100%, because when you look at that, the only way it really works is the leverage, right? So your general return is going to be okay. you might deliver to your investors, you'll deliver between a 15 to 20% IRR. If you hit it out of the park, you're probably 25%. Now, for you as the developer, because you're putting in less equity and you're getting your promote, you might deliver like a 60% IRR, which is great, but it's on very little capital, right? So when you're starting out, like it's me and my partners, we don't have a lot of capital to put into the business. So the amount of return we're able to get out of that project is not low. Like 70% of the profit in the project will likely go to our investors and like 30% to us, right? So that's great, but that's 5 years of work for very little absolute return. And the problem, the pro and the con. So we talked about how to address we took we talked about how to address we talked about how to address the uncertainty, and that was through time. One of the problems with that time, sorry, 1 second. Stella,
No problem.
one of the ways to address that is through time. But if we're addressing it through time, one of the ways you keep the lights on as a developer is you're earning management fees on the projects that you have. So the bank's providing financing, you're using that financing to pay fees to the development manager. The development manager happens to be you, right? You're the one running the development, so you're earning a fee to run it. If you're buying time, you don't have the site under contract. You don't have the financing in place, so you're not earning any fees. So all the costs related to that project, while you have it with the time to get the certainty, all the costs are coming out of your pocket. You haven't generally you haven't brought the investors in, you haven't got the bank in, so it's all coming out of your own genes. So it lowers the long-term risk, but it increases the short-term risk because you don't have money coming in to feed the machine. So generally, your way around that is you have to have enough money in your genes to survive to the point where, hey, now we've got to the other side of this, and we always have 3 to 4 projects that are being financed and are paying fees. Or what's happening is you do a combination of development work for your own account, and you do managed service development work for others. Right? So you say, hey, if all of our projects are in that stage where none of them are paying fees, we need income. So let's find a landowner who owns land, has a good cost base. It makes sense for them to develop it, but they don't have that development expertise and they need someone to navigate them through the process. Let's help navigate them through the process for a fee.
Yeah, that makes sense. And I suspect there are a lot of developers that underestimate this whole process, and they probably think that it's a lot easier. I don't think anyone would go into it thinking it's easy, but I think that they would probably assume that it's not as difficult as you're describing it to be, and complex. It's difficult, complex, and there's risk involved. And as prudent developers, you're trying to mitigate that risk as much as possible and to streamline it. But I'm guessing people that get into the development field greatly underestimate a lot of these factors, and they only realize it through experience. Would that be a safe assumption to make, or do you think there's people out there that can just come in and have success in this at the beginning?
I think it's very hard to have success at the beginning unless you're in a rising market. So a simple example is back when I was an accountant at KPMG, I had a friend, I think I had just left to join a large developer in the city as a controller. And I had a friend who was at KPMG, and he said, hey, me and some of my buddies are going to start doing like small developments off the side of our desk. Fast forward 10 years, most of those guys were doing like a 20-unit townhouse complex. One guy was building like a 50-unit rental apartment building. And so they saw success, but they saw success in a 10-year market of rising prices. So rising revenues cover all your mistakes. And it's why a lot of developers will tell you every 5 to 10 years they like a little bit of a cyclical recession in the real estate industry, because they'll always say it wipes out the doctors and the dentists. And what they're meaning, Chad, is those guys who think, well, hey, anyone can do development, so I'm just going to jump out there and start slinging some dollar bills and making money. And look how great I am at it until the market corrects and it wipes them out because they actually didn't know what they were doing. And so in a market like we're in today, they will fail because revenues will not correct for their mistakes. One of the things I appreciated our president saying when I was at Mosaic, which was the shop I was at for the last 11 years, was he would say, we don't need a rising market. In fact, a rising and falling market isn't good for our business. We just need a market to be flat or have, 2% inflation in prices. That's all we need because we know what we're doing. We can make money in that market all day, every day. We don't need the revenue to cover up our mistakes. Let's have a flat housing market and we'll make money because we're good at executing on the details. So I would say that would be key. On the other side, I would say that even people who, for example, have a lot of experience in industrial, you could have been doing that for 15 years. And then you say, hey, I'm going to build a small townhouse project, or I own some land. They've just changed the rules. I can do a tower here. I'm going to do it. Now, the problem you're going to have is you're going to think, well, I can just hire an architect and they'll do it. But that architect isn't going to necessarily have all the other aspects that you want. Like generally what we would say is if we're in that development management service role, we'll very quickly more than pay back our cost. And so it's simple things like, hey, we know that they're changing the rate of fees for development applications in Seattle on this date. And if we get our permit application in on May 28th, it's this rate. If it's June 1st, it's this rate. So we'll push that architect hard in all the trades to get the drawings to a state where we can submit and pay $500,000 less in application fees. And if we're making $750,000 to manage that entire project through to building permit, you just paid for yourself, right? You're able to have conversations with trade and consultants and better relationships and get better pricing. You're able to take what the architect gives you and you're able to look at it through a lens of, well, I've done 100 of these projects. Here's how I would change this floor plan so it's more rentable, it's more saleable, it's more leasable, what have you, right? Because the architect, you're going to tell them, hey, we want this many 2 beds, this many 1 beds, this many studios. They're going to slice and dice and they're just going to throw something at you. But they're not going to optimize every one of the floor plans in that plate for maximum leasability if you're leasing or maximum saleability if you're selling. That's going to be your job as the developer. But if you don't know that, you're not going to know what you need to do. And I'll give you a simple example on that one. Was talking to a group recently. We're looking at general contractors to build a rental tower. And one of the guys we met, his family's been in the industry for about 40 years. For a lot of that, they were a builder, and then they started doing their own sites, and now they're one of the biggest developers and builders and rental owners. So 3-pronged strategy. And so now they will offer property management services to third parties because they've built up a significant portfolio for themselves and for others, and so they feel like they have the experience. One of the things he said was, we won't sign up someone as a client to lease up a new building if they haven't done the right process. If the homes aren't the right size, if the building is under amenitized, then we can't actually lease it up at market rates because they've made mistakes. So we're not going to sign that client up because we can't achieve what they're going to want us to achieve. We will only sign up a client who's designed the building right, who's put in the right amenities, who's made sure the units are the right size. Generally, people err on units that are too large for rental, and you can't hit rental rates because you're trying to get a per square foot rate, but you can only rent a 1 bedroom or a 2 bedroom for so much. So you have to have that fine line between hitting the per square foot that matches with the number of rooms. And so that takes a skill that the average person, or even the average person in the development industry, or someone who's switching product types, isn't going to have. You want in that situation, you don't want general expertise, you want very specific expertise.
Yeah, as it would relate to industrial as well, I see a ton of parallels there. Is that you need to fully understand exactly what the tenant wants or the buyer wants, but you also need to make it economically viable so that you can build it and profit in the first place. So you're trying to marry these two different ideologies of tenant demand versus economically feasible. And to try and do that without that very narrow expertise that you described, and you only get that narrow expertise by doing it. You can't read that in a book. There's no hand guide out there. So the experience factor is so large, and I think that emphasizes it even just beyond development. I think expertise and knowledge and experience is so underrated that this goes off a little bit on a tangent, a little bit of a rant, but I see AI and something like ChatGPT all of a sudden giving false knowledge or the illusion of knowledge to somebody that might just go on and say, what would a building in Vancouver need to look like so that I could maximize it for the tenants and also be feasible. And ChatGPT, in that specific example, might spit something out, but that's not going to be a replacement for actual local expertise, that narrow focus and that experience. So this is going to be fascinating for me going forward as we deal with this wave of AI giving that false illusion of knowledge when you just can't replace it. You can't download your brain and put that into a large language model and have it now give everybody the same information that you have. It's just not possible. That expertise is indispensable.
Yeah, it might be good at rules of thumb, but it's not going to be good at the intricate knowledge that you need. Like, you're going to look at how much do buyers value mezz space? What's too much mezz space versus too little? If we have mezz space, do we want it fitted out or do we just want it shell? How many bathrooms do we need in that mezz space? Like, how many bay doors do we need for every square feet? How does that number of bay doors change based on the scale of the building? Like, ChatGPT might have general rules of thumb, but it's not going to know how those details shift with every change in square footage, user type, area, geography. And so you can run into the problem of relying on general knowledge to solve a very detailed, specific problem, which can get you in trouble.
I love it. It's the power. It's the benefit, and it emphasizes the benefit of having an expert in anything that you do. Medicine, law, engineering, architect, development, all the major things. There's AI in my mind, and hopefully it never does, because I think having that human element is so imperative. But I think that does just really emphasizes the value of expertise. So thank you for sharing that. Just with the last few minutes that we have left, and that this time has flown by, because I could talk to you for hours and get your thoughts on this. I know you're an avid reader. Anything you're reading lately that others might be interested in?
I've taken a little bit of a break from nonfiction, and I've mainly been reading for fun for the last 6 months, which has been nice because I hadn't for 3 years. While I was deep in my podcast, I was interviewing an author every week, so I was reading their book and then talking to them. Some of the ones that I liked along the way, I liked Built to Move by Kelly and Juliet Starrett. That was a fun read. I liked the idea of Die with Zero. That was definitely a fun one. On my to read list is Sahil Bloom's book. I think I kind of live a bit of the life that he talks about in there, but I know there's room for improvement with like a bit of a balanced scorecard of your life. And right now I've started reading. I got to jump back into it. Is this Never Eat Alone? I've had it on my shelf for a long time, but I hadn't read it. So I've been diving into that, and I'm trying to go deep on that one. And I might get a little bit more involved on the deal side, acquisition side. So I need to be out there having conversations, talking to brokers, having lunch, and just building relationships and adding value to other people so that there's opportunities coming back from them. So I'm gonna stick with Never Eat Alone. Sorry, long answer.
No, I loved it. I haven't read any of those ones you mentioned except for Never Eat Alone. That's on my bookshelf. I think I've read that twice now. Fantastic book. He's written another one as well, which I hadn't picked up. So that might be one I have to dig into as well. It was a second one too, Never Eat Alone. I don't remember the title though. But yeah, if I do read it, I'll share it with you because it'd be pretty interesting. And then you've got a podcast going as well, Be a Nice Human in the background. It's a great message. Can you tell me a little bit about your podcast? Is it more focused on authors or how does that go?
So what we have is we have a podcast and a newsletter called The Growth Guide, and we've had that going for the last, it's been about 4 years now. And on the podcast, we have conversations with authors. So it's basically a book club with the author. So I read their book. What are the top 10 to 15 things that really jump out at me? And then I just talk to them about them and ask them questions and get them to kind of talk through the main points in their book with me. So it's not, it's a bit different. Like a lot of authors will go on a podcast and they talk to the author for about an hour and they only spend about 5 minutes on the book. So usually they finish the conversation with me and they're like, wow, you actually read the book. And I'm like, well, yeah, I talked to you because I wanted to read your book and then I wanted to talk to you about the book. And then what I do on the newsletter is I write a weekly newsletter, and the idea is just what's happening in my life and how is that relatable. So yesterday chatting on the Vancouver real estate podcast, we talked about, it's really jumping out at me over the last 9 months. We've been moving houses, getting reset up, starting the business, and I've fallen out of habit, rhythm and routine. And so I'll write tonight an article about the importance of rhythm and routine and which is your daily habits, rituals, acts, and say, hey, here's what I've noticed in my life. Here's the negatives. Here's what I'm going to change. Here's how you can apply this in your life. And so just basically what's happening and how can that help the reader in their lives.
Very cool. I'll put links to both of those in the show notes. And then I'd also encourage people to connect with you on Twitter. That's how you and I first connected.
And my main spot. Yeah.
Yeah. And you great content there. I would highly recommend people connect with you on Twitter or X, I guess, as it's now called. And yeah, just wanted to close out by saying thank you. It's every time I do one of these podcast interviews, the ones I find are the best are the ones where I'm like, oh man, we're out of time. And I'm very respectful of everyone's time. So I always try to keep it to an hour. But this one, I just felt like I almost had to cram a few extra things in at the end real quick as I wanted to cover it. But we just had such a great conversation. So really do want to thank you for taking the time to jump on this with me.
Thank you. This was a blast, and like you said, it's a topic we can both talk about all day, every day. So look forward to someday talking again on the show when we've got some more projects under our belt at Frame.
Love it. Yeah, we'll definitely keep in touch. I'd love to have you back on the show sometime down the road.
Awesome. Thanks, Chad.
Okay, thanks, Finn.